Evening, everyone. How you doing? Okay, so it feels like I haven't done one of these for a while. I was off all last week, so I got back yesterday pretty late. My first day back, kind of like working properly today. So yeah, I thought let's do a bit of a live, answer some questions, yeah, and see where we go from there. How is everyone, by the way? Let me just bring up the chat very quickly. Can you hear me all okay? Let's have a little recce just to make sure that we are okay with the audio and everything. I think we should be. Shouldn't be any issues at all because I've got all the settings here correct. Cool. All right. So, what is going on with this quality? Let me just see if I can check one thing, guys. One moment. See, I don't like that. It doesn't make that much of a difference. Okay, we're just going to roll with this. I need to have a look at doing something about this. Okay, sounds fine. All good. Hope you're well. Very good, Mustang. Thank you very much. Ian, how are you? Welcome. All right. Okay. So let's get into some questions. We'll give this as long as we have, basically. So this is the first one from Mustang. As a first-time buyer of a house, would you put down a bigger deposit for just the lowest amount you could possibly, or just the lowest amount you could possibly do? There's so many different options out there regarding this. If you're in a position where you can put a larger deposit down, I'd put a larger deposit down because it means that you're going to get a better rate from a mortgage point of view. Because there are things called loan to values. So your loan to value is how much are you putting down as a deposit in relation to how much you're borrowing in relation to the loan. Typically, higher loan to values carry higher interests, so rates essentially. So it means that your monthly mortgage payment will be much, much higher. And obviously, it will take you longer to pay off the mortgage as well. So if you're able to be in a position where you can put more down as a deposit, that will help you with a rate, basically. And it will mean that your mortgage payments will be much, much smaller. And potentially, it will shave off time off your mortgage payments as well. So, for example, if you were able to go for a 70% loan to value, right? So you're putting 30% down, borrowing 70% of your loan to value. Well, let's just say, look, £100,000, you put 30K in, your mortgage is going to be 70K. At 70K, your mortgage rates will be more attractive. So you'll get a lower mortgage rate than if you borrowed £90,000. If you can, if you're in a position, put a bigger deposit down. But it really does depend on, obviously, what your circumstances are and what your goals are. Many people will argue that you could also invest that money. So you could put, 20% down and invest 10K. That does have merit because ultimately you could argue that you might get a better return on the £10,000 that you invest rather than using it to get a lower mortgage rate. But at the end of the day, there is no right or wrong answer. You have to do what you feel is right for you and your circumstances. Some people feel as though putting a bigger deposit down gives them the peace of mind that they have a more manageable monthly commitment in terms of the mortgage payment. So with that in mind, you have to kind of have to consider that. But if you've got a bigger deposit, put one down as long as you're comfortable with it. I hope that makes sense. There's this one here. I need to check what the VWRL is versus the global all cap. I can't do a direct comparison right now. 1 second, actually. Let me see if I can. Where are we? ETF. I'm just going to find it. 1 second, mate. Give me a minute. What's the VWRL called again? Let's have a look at this one. No, that's not the right one. Where are we? We don't want bonds. It's not this one. Which one is it? Okay, that first one. Let me just grab the second one. Global All Cap, I think, is the index fund, isn't it? Let's look at the index. Yeah, this is the one you're looking at here. All right, what I'm going to do is I'm going to see if I'm just going to share my screen. Actually, I need to get those into two separate panels. 1 second. Okay, that's that one. And that's that one. All right, okay, let's do a quick look at both of them together, side by side. I'll share my screen in a second. Let's make sure I've got this one just minimized. Let me just get rid of that. All right, okay, cool. So let's have a look. Window. Let's have a look at the global all cap index fund first and foremost, right? So here it is right here. Let me see if I can get this. What's the best view for this? Let's use this one. All right, okay. So this is on Vanguard, by the way. So let's do a little bit of a recce between the two because they are different. Let me just expand this a little bit more. There we go. That's better. All right. So the global all cap. So if you come onto this one, the ongoing charge for this is 2.23%. The risk appetite for this. So most of the investment houses, they will actually they will score most of their funds out of 7. So this is a 5. And this is really, really important to note because ultimately your risk rating will determine where you are on the scale. But we'll come back to that in a moment. So 0.23% ongoing charge. This is your annual charge. There will be dealing costs and things like that involved in that, which is included in this, by the way, like transaction costs. But these are the big ones where you're going to have a bit of a difference. So this one's invested in 7,010 stocks. So essentially by buying this global all cap index fund, what you're doing is you're essentially investing in 7,010 companies altogether. Now, this will comprise of large, mid, and small cap companies in developed and emerging markets. So developed worlds will be the US, the UK, developed countries essentially, and some emerging markets as well. It tells you what the fund will attempt to do to track the performance of the index by investing in a representative sample of index constituents shares, remain fully invested and hold small amounts of cash, except in extraordinary market, political, or similar conditions where the fund may temporarily depart from its investment policy. Now, this hasn't been running for a full 5 years just yet. This is only 4 years old, which is why you don't see. Let me just get rid of this comment so that everyone can see this properly. Hide. So that's why you don't see this yellow bar, this gray bar, because it's only been running for 4 years. Now, whenever you're looking at a Vanguard chart like this, you want to be looking at the gray one, because effectively that is their performance. They use net asset value for their performance, but this is what you'll be looking at. But if we have a look at performance, I've got my calculator here. Let's just do it here and see where they are. I'll actually write this down as well because we're doing a comparison. It'll be interesting to see where it comes out and how it's performed in relation to the other one. So 12.84 plus 6.36 plus 4.38 plus 0.09. Okay, so that's 46.67 over the 4 years that it's been available for. So when you divide that and you do an average, it's about 11% per year, 12% per year. Like I said, the big difference here is this, okay? That's the number of stocks that it's invested in. So when you look at the performance, let's just go let's go to portfolio data, see where they are. Obviously, North America is going to be the biggest part of the pie. So that's the US essentially. So 61.5% in the US. We've got European exposure of 16.8%, Pacific, which will be places like Australia, that kind of area, the emerging markets, and you got the Middle East as well. Very little in the Middle East though. So that's US and Canada. So US specifically, you're going to have 58.7%, Japan, UK, China, Canada, you've got in there. So you've got good mixture of geographical regions in terms of its global exposure. You can also see sectors as well. Now, many people may argue that tech isn't the place to be if you're in an environment where inflation is due to increase, because tech typically, you're looking at future profits more than anything else. In an inflationary environment, many people will argue that actually more staple companies will be the best in companies to invest in. So people like Coca-Cola, because at the end of the day, regardless of whether and how much prices go up, people still need to have the essentials. So food, drink, clothing, that kind of stuff. So, 22.6% in tech isn't too bad. I'm just going to jot that down because I would guarantee you that the other ETFs, so the WRL, will be exposed to tech as well. But you can see the other sectors that it's invested in here, which has got a really good diversification, really, to be honest. And this is what Vanguard are really, really good at. These are the top 10. So like I said, there's 7,010 here. Actually, this one says 6,990. So I don't know whether they might have added some or some have come off. We won't know. But you can see the top 10 holdings here. And these are just names that you would expect anyway. So NVIDIA, Tesla, you've got the Google stocks in there as well, different classes as well. You've got Facebook, Amazon, Microsoft. And you can, if you wanted to, you can scroll through all of this. But there are 7,010 companies that you're invested in here. Performance-wise, 11.66 roughly on average over the last 4 years is what we can see here. Now, if we go and have a look at the VWRL, I just need to swap this screen very quickly to this one. Let me just expand this very quickly. Right, so remember, the other one was 0.23%, right? So this one's slightly less, so it's 0.22%. But this has got a more of a condensed kind of like stock selection. So it's only invested in 3,621. So they're not spreading the net as wide. They are constraining it slightly into, I would guess, as a result of more research, essentially. And that's their number, that's their pick. So performance-wise for this has been around for 5 years. What is this here? So 1.3 plus 1.32. So that's 67.27%. That's over 5 years. So that's about 13.45% roughly. So it's performed a little bit better than the global all cap. But then again, the global all cap was missing this year. So the comparison, if you're going to start doing comparisons, it performed the global all cap performed better in this period. I think it did like 6.3%. So it swings around about really when it comes to kind of this here, but a much more concentrated number of stocks that it's actually invested in altogether. Is there any difference in this? Let's just have a look quickly. Investment approach for physical acquisition of securities. It doesn't say or not whether you're going to have large, mid, and small caps within this. I would hazard a guess. Actually, what it says, large and mid caps. So what they're doing is they are not investing in small cap companies. So that's why you've got less of a selection here. Now, that could be a good or bad thing depending on how you're looking at it, really, to be honest. Some people will say small cap is way too risky, too volatile, and therefore you might want to exclude that from your selection to give your portfolio a bit less volatility. And I would imagine that's where a big chunk of the stocks have come down in their selection. And trust me, Vanguard will be very, very well researched, and they'll probably look at more than just sectors and how they filter down through sectors as well. But with this, you're only getting large and mid cap exposure. Essentially, you're not getting any small cap exposure. So if you kind of want small cap exposure, where you feel that there might be some really good chances to get some appreciation from the investment, that you might want to go for that. Portfolio as well, you'll just see that actually, where are we looking at geographical? 61.1%. That's Canada and US. I think it was 61.5% before. So it's about the same, actually, to be fair, in terms of the allocations. 58.6%. Where's Canada? 2.4%. You've got Japan, China, UK. So the exposure in terms of the geographical regions are pretty much around about the same. They're the same risk profile. The top 10 will probably be exactly the same. Microsoft, Amazon, Facebook, yeah, the top 10 is pretty much exactly the same. The key thing to remember is this is an ETF, so you'll be able to trade out of this pretty easily on a given day. Whereas on the index fund, if you wanted to get out, you would have to wait until 5 p.m. to be able to close your position. And the cost difference, it's only 0.01%. I don't know. It depends on whether you feel as though you want to trade out your position or not. If you're not really too fussed, then you could go for the index fund. But the ETF will certainly give you a little bit more flexibility with regards to it. I like ETFs because if you wanted to trade out, you could trade out. If the world were to come to an end, you got cold feet, you could just trade out. You don't have to wait until the end of the day. But on this occasion, what was the cost on this one again? It was 0.22%, wasn't it? Yeah, so you're paying a little bit less in comparison to the index fund. But the risk profile is exactly the same. You're not getting exposure to small cap with the ETF. You will with the index fund. So it's all about swinging and roundabouts. And this is where I talk about, your goals. What are you investing for? What do you want to achieve? Do you feel as though small cap is going to add value to your investment journey? Really, that's the big question. But yeah, that's just a quick recce of it all. That may have been useful, may not have been useful, but that's kind of how I compare some of the funds, especially if I'm looking at people from Vanguard to Hargreaves Lansdown or iShares. That's what I look at predominantly, and some other things as well, because this was a quick recce just to see what the fund is all about and what they're tasked to do. Let's have a look at this from Lynn. My employer only matches 3% of pension contributions. Is it worth doing salary sacrifice in excess of the match 3% if I could afford to do so? Yes, you'll definitely get the benefit from salary sacrifice if you do, because of the tax relief element to it. It's a shame really that they don't match more than that. I know some employers, they just can't afford to do so. They may not be big enough to be able to do it, but if you are able to do that, alternatively, see, if you salary sacrifice, my big question to you will be, where are you invested and who's administering the pension scheme? Is it being administered by one of the big professional pension administrators, or is it a nest pension? If it's a nest pension, then I would probably suggest that you try and have a look at your options. Particularly if you're in the default nest option, the performance isn't that great. So that would be my question. And if it is in nest, then you probably want to have a look at, maybe if you're going to salary sacrifice or try and pay into a pension elsewhere, you could look at a personal pension or a SIP. Potentially, you could. But if you are with someone like Legal & General or Royal London, then definitely get an eye on your pot. So where can you actually be invested? Because typically, if you've not selected a pension option within the pension, they will just go and put you in a default fund. And the default would be kind of like 50% bonds, 50% equities, or 40% equities, 60% bonds, relatively safe. And if you've got 10, 15 years, you want to get it into more equity so that you've got the time for it to try and compound for you over that period of time. So those are just a couple of things for you to consider. You can do the salary sacrifice, but have a look at your pension details first, who's administering it, what the options are, just to make sure that if you do salary sacrifice, you've got it into an environment that is going to be working hard for you. And you're just saying here, is it worth increasing the workplace contributions to offset next year's NI increase? Yeah, potentially. Yeah, because I mean, you're going to get the tax relief basically in according to the amount that you contribute. So if you increase your contributions, the 25% you get from the government will increase alongside that as well. You've got to make sure you can afford it, though. That's the most important thing, Lynn. Thoughts on hydrogen? Someone asked me this a few weeks ago. It's gaining big momentum in the US with ventures with airlines like Airbus and larger vehicles in vans and trucks. It's much better than battery. Until they have proper work case, like it's working, I personally won't touch it. It's all very good and sexy for it to be like the next big thing, but they need to prove that it actually works. They need to prove that it's applicable. Show me a plane or a van fleet or something like that is using it efficiently, without any issues, then it might be something that I would have a look at. But hydrogen for me has got a long way to go. And yes, innovation is great, and innovation in its infancy is a great investment opportunity. But I'm not the kind of person that will go for um, infant innovations straight off the bat. I need to see that it's tangible, that it's workable, then the technology actually works. I mean, it's simple things like, Nicolau. Nicolau recently had been in the news because, well, guess what? Fraud. And people were harping on about Nicolau all last year. And I was just saying, look, they haven't got a working product. Until they have a working product that they can show to me, I'm not going to touch the stock. And it's true. We should not be listening to hype of whatever the news is saying or whatever people are saying down the pub when we're looking at investing money. Because at the end of the day, you never really know what is real and what is not until you see that there is proper traction within the business. And when I say traction, let them start selling their vehicles, let them start selling their product, let them start building a track record. Then I'll have a look at it. But at the minute, I won't touch hydrogen. I think it's got way too far to go for it to become viable at this point, unless something massively changes and there's demonstrable applications for it where it really works in the real world. Then I might have a look at it. Evening, Matt. How you doing? Longer mortgage or shorter one? In your opinion, what would be best? I'm also trying to wait until the house market slows down, but not sure if this will even happen. Yeah, I mean the house market is, any market is really important. Is difficult to judge because you just don't know whether it will slow down or it won't slow down. Depending on what goes on. I mean, there is talk of interest rate rises and stuff. So will that impact people? Possibly, possibly not. It's hard to say. But in regards to a longer or a shorter mortgage, I think the answer to that question is kind of an answer back to you. Would you feel more comfort in knowing that your mortgage is paid off 5 or 10 years earlier than it would normally be? If the answer to that is yes, then you should go for a shorter term mortgage. If you're not really that bothered and you think, well, actually, you know what, as long as it's paid off by this time, I don't really care, then go for a longer mortgage. It's a funny thing, really, because the roof over your head is probably going to be one of the biggest assets that people that you're ever going to buy, one of the biggest assets that you will acquire. And for many people, when they talk about the roof over their head, because a mortgage is typically going to be the biggest of your financial commitments in terms of your monthly expenditure, a lot of people put a lot of weight in making sure that they can pay down the mortgage earlier, simply because, well, it means that I don't have to worry about my mortgage anymore, which is the biggest outlet. And that means they can take that money and they can allocate that into other things, be that investing or going on holidays or just finding balance. This kind of stuff can really, it can really free people. I know people who have paid off their mortgage early and they're like, actually, you know what? I hate this job. I don't really like this job in the first place. I'm going to go do something completely different. And I'm only going to work 2-3 times a week. Those kind of things are really important. The question is, where does it fit within your, what does that look like for you? Would you rather pay off the mortgage so that you have more finances available for things that you want to do to make life enjoyable, to build for the future? Or would you prefer to just have it longer? It's not a question that I can answer for you, mate. You kind of have to think about it from your own point of view and try to envision what you want your life to be. Money is a tool, life is for living and everything. So you need to make sure that you position yourself and you get things in place that will benefit you and give you the life that you feel you deserve. What are the VUSA income versus VUAG accumulation ETFs? Thoughts? The VUSA is the Ftse 5, the S&P 500. I didn't think that they had an income for that. I'm not sure that they do have an income for that. They definitely don't have an income version of that. So I don't know. Is that the right one, Janine? Even if I just go and have a look at it now, I know that they don't have unless they've just added one. I'm looking at the US here. Yeah, they don't have an income version of the S&P 500. The VUAG, you'd have to tell me which one that is. You'd have to tell me which one that is in order for me to be able to look at it. I mean, but the thing is, right? If you ever look at anything where it's got income next to it and accumulation, like income means it is going to be paying out whatever like dividends or growth it will acquire or build for you. Accumulation is basically having that reinvested. If you're relatively young, you want to be going for accumulation all day long. I don't know that people are obsessed with passive income these days, investing for passive income and all that kind of stuff. But my big belief is that if you're in your 20s or your 30s, whilst you've got the time, you've got the energy, you've got the power to earn money, that's where your focus should be. It should be about earning money, then allocating that into investments so that you can accumulate for later on in life. A lot of people are doing it the opposite way around now. They want passive income now, but how do they then create wealth and how do they actually make sure they're able to grow their passive income base? Those are just my thoughts, maybe an unpopular one. But most people that I've worked with have always focused heavily on accumulation. So it's all about, right, what can I acquire over the next 10, 15 years? Because I know that I'm going to retire at some point. Or I want to retire early and I need this money to be able to provide me an income. But that's a big difference. But I don't. The USA is typically the S&P 500, and they don't have an income version of that fund. They just don't. Pete, in your humble opinion, what is the best S&P 500 stock? As there are so many S&P 500 stocks like VUSA. Okay, look. So you've got the VUSA, which is the Vanguard option. You've got an iShares option. You've got a Fidelity option. Like predominantly, they are all invested in the same thing. The difference is that iShares, which is a BlackRock, might have a different top 10, or they might allocate the money within their funds to different companies in comparison to someone like Vanguard. The only way that you're really going to find out whether there is a fundamental difference in how the money is invested across those companies is if you literally sit down with the fund fact sheet and the key investors information document and actually look through it yourself. But fundamentally, they are all invested in pretty much the same market, the S&P 500, which is the top 500 companies in the world. Cost factor is obviously really, really important for those. So that's worthwhile bearing in mind. But which one is best? I think the VUSA, which is the Vanguard one, is the most popular one because the price point is so low. And it's not just retail investors that buy this. Other big fund managers, advisors will buy this for their clients because it is one of the cheapest ways, if not the cheapest way, to access the S&P 500. Period. So, yeah. Okay. There's a follow up. I'll just send your follow up, mate. One sec. Um, I like the VUSA, but have VUSA in Invest Engine as VUSA not available today. Right. Okay. You're saying so you've got which one is the IUSA? Hang on a second. Where are we? Where are we? Where are we? It's not going to remember my thing. Why did I do this? I thought that they did have the VUSA available with Invest Engine. I may be wrong though. Let me just double check. What was my thing? Okay, which bar did I use for this? I can't remember my login details for Invest Engine. Let me just see if I can access via my other. I've got so many apps that I'm using at the moment. It's unreal. It's actually it's quite stressful remembering where I've got everything. like just put in very different places, and I definitely need to streamline because it becomes really frustrating, and I can't remember my password. I can't remember my login details for it. That's really annoying. All right, I may not be able to have a look at this live with you. Let me just try one more time. But I was sure that they had the S&P 500. If they haven't, I don't know what the IUSA is though, mate. I mean, I typically in these is iShares. It might be BlackRock, but I don't know what that fund is. So, because the BlackRock, I can't remember, what is there? Hang on 1 second. Let me just try this one more time. Let's try this one. No, okay. No. I really want to have a look at this. Sorry, guys. I really want to have a look at it. No. Okay, cool. I can't have a look at it. Let me just do this though. USA. Oh yeah. So, yeah. So it's the BlackRock version of the VUSA, which is the Vanguard S&P 500 fund. So the IUSA is the BlackRock version. BlackRock is still a very good like investment manager. I mean, they are, if not the biggest in the world. They are very good. When I was working in Canary Wharf, I worked with them really closely because they managed one of our pension funds. Really knowledgeable, great team. Let's have a look and see. Actually, I don't know if I'll be able to do this. I'll see if I can share the screen. But I wonder if they will have a different top 10 and allocation to the holdings here. Let's just have a look. 1 second. Okay, there it is. Let me just go back to Vanguard and bring the VUSA up. Where is it? I'm in the index fund area. Right, ETFs. USA. Here we go. Portfolio data. Okay. So if I look at their top 10, they have pretty much the same. Berkshire Hathaway, Class B, NVIDIA. Okay, but okay, so this is what I'm talking about. So it's a shame I can't show this in side by side in one window, but I'm just going to do this very quickly. So this is the BlackRock IUSA, which is the S&P 500 one, right? So notice here, right? So they've got 6.01% allocated to Apple within their makeup. If you go to the VUSA, they have 6.13% allocation. Right, so the next one is Microsoft. So Vanguard have 5.74% allocation. They've got, so BlackRock have got 5.95%. Then you go to Amazon. Vanguard have got 3.82. These have got 3.83. So not much of a muchness, really, to be honest. Then you got the Google. You got Class A and Class C. So they've got Class A 2.22, whereas with Vanguard is 2.29. Then Class A 2.17. So a little bit more. Class B, they've got 2.8 in BlackRock, and Class B, well, actually they hold Class C. So Class C 2.06. So a little bit more. So this is where you're fundamentally going to see the difference, right? They may have different allocations to the companies that they hold in the top 10. Now, if you look at the ETF, the VUSA Vanguard ETF, the top 10 are pretty much identical, exactly the same. but the weightings are different. And that weighting will be pretty much, I would imagine, different across all of the 500, not just the top 10. But you've got to think about it, where it feels as though, it's only 0.08 here or 0.07 there. That can have a really, really big impact on the actual performance altogether. I mean, how much is, it should be mirroring the performance either way. Let me just have a look and see if I can actually find this. So what is this one? So 16 to 17, total return on was 17.99%. If we go to the Vanguard one, 16 to 17, 18.15, so 18.15%. So the Vanguard one actually performed a little bit better that year. So this year right here. So 18.55% for Vanguard, 18.15% for Vanguard versus the 17.99. Again, you may think not much of a muchness, but over, say, 10 years, that 0.1% or 0.15% will actually add up. In 17 to 18, this one did 17.52, which is better than the Vanguard result, which was 17.43. In 18 to 19, 3.9. Vanguard did 3.88. And then 19 to 20, 14.76. Vanguard did 14.79. So they are on par with each other. Then, 2020, 2021, 29.66, 29.65. So small little bits of underperformance or outperformance when you compare the both of them together. It's those little numbers, those little differences that will make a difference accumulatively over time, though. So I know that's a very, very long-winded answer to the difference between the two, but it's important to acknowledge that sometimes when they're building these funds, because they are professional investment managers, they will think, actually, we will just want to put more money with Apple this time because we think Apple's going to do better over the next cycle, over the next 12 months or so. Roy, how you doing? Welcome. Ace, how you doing, bro? I'm really, really good, mate. I'm really, really good. Okay, V3AM. Mate, can you give me the actual name for it so I can have a look for it? I don't want to have to go through all of them because there's quite a few ETFs in there. So you can tell me whether it's global or whether it's to a specific region. How do you find stocks to invest in? What metrics do you look at to evaluate a stock? So if I do have individual stocks, but my approach is I have a ton of ETFs in index funds where the majority of my money sits, and then I hold companies that I'm interested in around the periphery. So people know that I'm big on Tesla. I've got Tesla stock. I've got quite a few individual stocks, but basically what I look for in companies is I want to know that the company has been around for some time. And that when I say some time, that doesn't have to be, 10, 15, 20 odd years or so. I have got some new companies actually that are incumbent. So I've got the likes of Neo, for example. I've got Neo, which is a relatively new company in comparison to some of the legacy businesses that are out there. But what I'm looking for is a company that basically is solving a problem, that is already making sales and they already have a client base that is active to their service or to their product. If they're doing something that is very, very different. So for example, like Tesla, groundbreaking, trying to move the planet onto a different place in terms of travel. Like they want to electrify and move from fossil fuels to electric driving. And they've changed that entire landscape in terms of that. So I look for that. But when you start looking at the accounts and stuff, really what you're looking for is a company that is turning over good money, hopefully in a position where they are making profits. And that wasn't the case for Tesla for a very, very long time. But for Tesla, what made it different for me was because I have the car, I've driven the car, I interact with the company quite a bit. I interact with the owners groups, and they're very, very good at communicating with owners as well. I knew what the product was all about, and I knew the enthusiasm that people had around the product when they actually bought one or when they drove one, or just that general usage of it and how people felt about the actual product. There's a lot of goodwill when it comes to Tesla in terms of being first to market with this kind of stuff, and the fact that they just made it interesting and sexy. So they weren't profit making at the time, but you could see the potential in the business. But ideally, I like to think that they're in a position where they are making product profit, or they have they're into a position where they can start to make profit. I do have a look at who actually runs the business. So, for example, Elon is a huge draw for most people who invest in Tesla, because he's got such a massive track record, PayPal, and all the other ventures that he's sold into. What he's doing with SpaceX and all of Neuralink, Starlink. The person behind the business is a really big draw. So in my research, I will have a look at the management team. I will have a look and see, well, actually, you know what? If it's not someone who is of international note, like someone like Chamath or Elon, or I don't know, who's a really good one, Richard Branson, I'd want to go and have a look and see, right, so what's the leadership team, what's their experience in this sector that they're building. I mean, one of the big allegations that's labeled against Nicolau is that the chief engineer or the head engineer he had no experience whatsoever of like engineering in terms of the motoring sense. He was an engineer in a completely different field. That's really important. So obviously going through, the fundamentals of a business. Are they making money? Are they making profits? Do they have a good balance sheet? Are their sales and their revenues like increasing year on year? If not, what's going on? How much are they spending for things like marketing, that kind of stuff? You can find this all in the financial accounts. If they are spending more on marketing, is it being reflected in sales the following year? Because oftentimes you will see that there's a massive sort of outflow of cash within that accounting section. But does that translate to sales later on? Is it a company that actually has to advertise heavily in order to sell their product? Or do they have an advantage in the market space that means that they don't have to spend so much money on marketing that they're difficult to compete with? All these things are really important. Those are the things that I tend to look for. And that's one of the reasons why I don't naturally go for brand new companies like hydrogen companies, for example, or even Lucid. I haven't touched Lucid, got no interest in it at all. The car is amazing. If I went from a Tesla to anything, I'd probably go to a Lucid, because the car looks phenomenal, like really amazing. But they're not selling the car at the moment. They're still in development. So until they're selling the cars, making some sales, my money's not going anywhere near it. But that's my approach to investing. A lot of people would rather be invested in a number of startups because the risk versus reward balance is way higher, right? You can make way more money if you get into a company very early on. But you have to acknowledge as well, when you do that your risk factor is so high. And a lot of businesses fail. And that's just the reality of investing. So my approach is looking at companies that are relatively established, making good money, and then I basically do my research based on those factors and decide from there. What platform would you recommend for personal pension? Easy ones, Pension Bee. I talk about Pension Bee quite a bit. They've been on the channel. They're really good. I mean, I've got my own pension with them, so I would recommend Pension Bee. But you can use the likes of like Moneybox. They've got a pension. Money Farm. They've got a pension. Who else has got a pension? Moneybox, Money Farm, Pension Bee. Those would be the three that I'd mention. But I think Pension Bee purely because is the one that I've got my money with them, purely because they deal with pensions specifically. And the pension arena is actually quite a big arena. There are a lot of moving parts, especially if you're looking at transferring pensions and doing all this kind of stuff and trying to consolidate your pensions all in one place. Having a dedicated team or a company that does that specifically means that you find that the customer journey and what you'll experience with them is a little bit better. I'm a little bit biased, I have to be honest, because Pension Bee have done phenomenally for me in terms of my performance and stuff. They've been really good, and I speak to the team quite a bit there. So I'm a little bit biased, but Pension Bee, Moneybox, and Money Farm. One of the three. There are links to Pension Bee in the description to the video and stuff like that if you do want to consolidate. So yeah. What's the max for a personal pension? So the rule is that at the moment, the current annual allowance is £40,000. When I say annual allowance, it's the amount that you can contribute into your pension. That's the maximum you can contribute per year. But the caveat is this: you cannot be earning 25k, then go and put 40k into your pension. So you have to be earning over and above 40k in order for 40k to go into your pension. So if I'm earning, say, 120 a year, then yes, I can max out £40,000 in my pension. If you're only earning 25,000, then you can't go and put £40,000 in. So you're capped in that way. But the maximum amount in terms of the annual amount that you can put into your pension is £40,000. The maximum amount that you can accumulate into a pension over the course of your working life is £1 million now. It's called the lifetime allowance. It's £1 million is the maximum. There are some tax penalties if you go over $1 million, but if you get to the point where you've got $1 million in your pension, it's a good problem to have, and you can mitigate that anyway. There's lots of things you can do. Can we invest in the S&P 500 accumulation on Vanguard UK? Yes, you can. You've got the ETF, the VUSA. That's an accumulation fund. So yeah, you can. Someone sent a super chat, by the way. Let me just say thank you for this. Ian, where are you? One second. Well, let me just get this up. Thank you very, very much for this, mate. Really do appreciate it. Thanks for sticking it out, Pete. An explanation was superb. You're a star. Thank you, mate. I appreciate you. Thank you for the super chat as well. Let me just go back up, see where we are. Okay. I'm way up the list, so I've got to try to speed this up. 1 second. Where are we? Ah, Anna, how are we doing? Haven't spoken for a while. How are you? How do ISAs make money? Do they buy and sell shares every now and then, or wait after some time to allocate your percentage? I'm lost on the gains and losses and how it operates. Okay, so typically speaking, right? So if you invest money into something like an ISA, like it's an investment. So if for example, you go into an ISA and let's just say you buy the S&P 500, because this is the one that's popular on this live, right? S&P 500, you can have that in an ISA. Now, everything that Vanguard offers you is a passive investment, which means that it's always going to remain the same, which is the danger of a passive investment. Because if the market were to crash tomorrow, like everyone's saying it will, right? Where Robert Kiyosaki is talking about the biggest crash in history. If he is right, and the market just literally just decimated tomorrow, your passive investment will basically just trail off, because a passive investment is simply there to track the performance. If it's going up, it will go up. If it's going down, it will go down. So typically speaking, if you're in a passive fund, if it goes up, it will go up. There is no selling or buying that happens in that whilst you put your money in this. You put 10K in, there is no buying and selling apart from when you buy and you sell to close your account. There's nothing happening in between. Now, if you are actively managed, so you've got a team of investment managers who are looking after your investment, looking at the markets, and the one brand that I will shout out who does this is Money Farm. I've got money invested with them, and they've rebalanced my portfolio twice in the last 6 months, because they're looking at the markets thinking, okay, we don't like what's going on here. We don't like the predictions for this. So what we're going to do is we're going to move money out of this sector and we're going to put more money here. So they've recently done that. And interestingly enough, they dumped small caps in their last rebalance. So there will be buying and selling if you have active management as part of your investment strategy, or you're using someone who provides an active management service like Money Farm. So that's how it tends to essentially work. I'm actually looking at, and I've already got the numbers for it, but I'm actually going to be doing a video in the next couple of weeks talking about active and passive investments, because my active investments have actually outperformed my passive ones. And a lot of people talk about you should be invested passive because it's low cost. It's not about being low cost. Low cost is great, and it is a really, really important point to note. But I have one of my investments this year alone that has done 23%. My Vanguard from when I entered, if I average it out, would have only have done 8% this year. If I annualize my performance from when I entered, 8% is a big, big difference to 23%. Huge difference. And that is an actively managed fund where I'm paying a little bit more in terms of the fee in comparison to my S&P 500 investment with Vanguard. And that's what people should be looking at. They should be looking at, right, okay, so where is this invested? One of my other ones has done something stupid like 25%. Again, actively managed. I'm paying fees for that. So actively managed isn't necessarily a bad thing all of the time. What you need to be looking at is, right, more than anything else, where they invest in and what does the outlook actually look like. So when you're doing your research, it's all about looking at where they're investing, why they're investing in that area, what they believe will happen with the investment into those sectors. So for example, I've got one of them, which is a future world fund. That one's done phenomenally. And that is invested in technology for the future. Done really, 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 really well. But again, it's actively managed. It's not passive. So there's a big argument at the moment around active and passive management. If the markets are going to be volatile, should you be investing actively or passively? It's one that people really do need to kind of like ask themselves, because it is an interesting conversation to have. It really, really is. Kevin, thank you so much, mate, for this super chat. I really do appreciate it, mate. Thank you. It really does help as well. Thank you. Right, so let's go back up here. What do people mean when they invest in shares from an ISA? Do you have to pay tax on profits from shares if you at some point out them into an ISA within the same year? Put them into an ISA. Okay, cool. So look, anything that you've got into in an ISA is completely tax-free. It doesn't matter if it grows 200%, 300%, it will always be tax-free as long as you leave it within the ISA wrapper. So, you can, for you to invest in shares, so shares are equities, shares are companies, VUSA, that's an equity, that's a share portfolio. So as long as you have it within your ISA account, it'll be completely tax-free. You don't have to worry about the tax. I have an ISA with Money Farm and Help to Buy ISA. Correct me if I'm wrong. Is the 20K including both ISAs? IG so far? Yes, it is, mate. So your allowance for your ISAs is £20,000 per tax year. Your Help to Buy ISA, I think, is £4,000 maximum. So it is 20K across your stocks and shares, Help to Buy, and any other ISA that you might have. So it's 20K across both of them. That is your allowance. Your recent interview with True was extremely good and thought-provoking. Thanks. You know what? Thank you. To be honest, I don't know what's going on with views at the moment. I really, really don't. I'm looking at it thinking, okay, am I doing something wrong? Do I need to change something? Or I have no idea. But look, I knew that is a long form kind of like video, and it was such a good conversation. I wanted to put it out there. But I knew that it was never going to be viewed, because attention spans are short, and if it's not buy this stock now, most people aren't interested. So it was a label of kind of like, should I do it, should I not? But I just thought, actually, I will do it because it's something different, and it's a conversation that I had on the podcast, and it was a really, really good conversation. And I think sometimes, because obviously we talk about money here on the channel, and mainly it's investing and all this kind of stuff, but you have to earn your money somehow. And I know a lot of people who watch this channel are business owners, and True's one of those people where he has been in business for quite some time, and he's very, very, very well recognized and very, very successful, but he doesn't sugarcoat his success. He's like, listen, it's been really, really hard, and he's more than happy to share. And I think sometimes when you come across people like that, just listening to what they have to say. I mean, I'm in business for myself. Like, this is my full-time job. It's like I spend 3-4 days a week making videos, like preparing, shooting, editing videos for 2 days a week. I do one-on-one coaching. I do corporate work. Like it's a lot of work. And I tell you now, a lot of stuff that he spoke about, I'm going through right now. I am, because you're constantly thinking about how can you improve your business, how can you actually grow your business. And I thought it was very, very insightful and a video that was worth putting on. So I do appreciate you saying that, because it hasn't been viewed at all. It's barely been shared because it's not sexy, if you will. But you saying that you found it insightful, that makes it good enough for me. So thank you. Just want to shout out you as well, giving many nuggets. No, cheers, mate. Appreciate it. What do people mean when they say they invest in shares from an ISA? So what they basically mean is they're buying things like the S&P 500 in an ISA account. So hang on, let me just share this again. 1 second. No, I need a this window. So every single option that you have within Vanguard Swift, you have within an ISA. So as you see it here, right? That section right there, it says ISA ready. So you can go and buy this S&P 500 fund in an ISA if you wanted to. So that's what they mean when they say that they're investing shares in an ISA. They're investing in something like this, or for example, in a company like Tesla or Amazon or Facebook or Apple within an ISA account. So how you basically do that is you will go and open an ISA account with Vanguard or whoever it is that you want to choose. And not all providers obviously provide ISAs at this point in time. I think free trade is probably the one where most people are going to, but you've got to pay, I think it's £3 a month or something like that for their ISA. There's a fee for it. Trading 212 was the one that did everything for free, where you could have an ISA, but they've not been opening an account for a number of months now, since the beginning of the year. So that's what they mean. It's like they've got an ISA account where they are investing in either this or individual shares, companies, basically. So yeah. All right, I haven't done this yet, and someone just reminded me. Yes, they reminded me, Profit Boss. Please, guys, do smash the like button. There's 64 people on there. We've got 32 likes right now. So if we can get it up to 40, 45, that would be amazing. That really does help me out. It really, really does. So thank you. Josh. Hi, Pete. Can I get your top 3 choices for ETF index funds available on Vanguard, please? I don't have a top choice, mate, if I'm honest. Purely because it's not about the choices of which one to actually go for. It should be about the philosophy of what you want to achieve based on your goals. So, I always say you start with tax efficiency first. So no brainer, you need to go and get an ISA within Vanguard, period. You don't go and open a general investment account or pension account. You go and open an ISA first, because that's the first port of call. Then from that point onwards, thinking about, okay, mitigating risk, you should be looking at global funds or global investments, whether that be an index fund or an ETF. You want something global, something that is invested in the US, the UK, Europe, China, emerging markets. You want global diversification because that will help you manage your risk. So depending on what you've got there, and again, whether you want to be invested in mid cap, small cap, or large cap, or whether you just want small cap companies or mid cap companies, you want to leave out the large cap, those are all things as well that are worthwhile considering in terms of how you invest and which of these index funds or ETFs you choose within Vanguard, because each of them will have a very different objective and a different way in which they're set up. So it's not about what the top 3 are. It should be about, okay, what is your goal? How long are you investing for? What level of risk are you willing to take? So you high risk, or are you relatively low? Actually, you know what? I'm only investing for like 5 years. I don't really want to have a ton of money sort of invested in the market, with the market potentially crashing or lots of volatility within the market. Those are all your guiding principles that lead you to the index fund or the ETF that you should be investing in. So there's a lot of questions on there. The kind of stuff that I do in coaching really helps people get to the bottom of that. So what does that actually look like? What are your goals? And we do timeline planners and stuff like that. How far ahead are we into the future? Then we get down into, right, okay, what are the selection, the choices that you have available to you? Because to be honest, mate, all of the index funds and the ETFs, they are 100% equity funds. You've got no bond exposure at all to that. You've got to ask yourself whether, based on your goal and based on your investment time horizon, whether or not you should be having bonds in there or not. These are all questions that I don't know. So I hope that it's not about top three choices. It's about what your philosophy is to help you arrive at the best index funds or ETFs for you. This is really good. Cheers, Mustang. Appreciate it, mate. How do I pay tax on profits I make from shares if I reinvest them into shares to put them into an ISA? Well, look, your profits, I mean, you've got capital gains allowance, which is 12,300 quid. So you need to make sure you're tracking your stuff. But if you're moving things around, I mean, there are crystallization events. So a withdrawal is a crystallization event. But the important thing is capital gains tax allowance is £12,300. Each time you sell, you just need to know, what did you buy it for? What did you sell it for? As long as you're below the £12,300 limit, you're completely fine. You haven't got to pay any tax. If you keep track of it and you're over the £12,300 limit, then you have to pay tax. So to be honest, mate, it's your job to track what you're buying and selling at any given time. Of course, if you have it in an ISA, you never have to worry about it because it's completely tax-free. I appreciate that. I've just seen the second part to this. You've been sharing the content. That really helps me, guys. And if you do find any of the videos useful, please do share it and like and comment and all that kind of stuff. It really does help with the algorithm. The algorithm. Yeah. Oh my God, we struggle with the algorithm every single day. It's it's a roller coaster. Let's put it that way. This is a good one. I haven't reviewed Revolut just yet. So I can't really say, mate, if I'm honest. Maybe it's one that I need to have on my list I need to add it to my list, but it's not one that I can comment on because I've not had a look at them properly. Okay, so this is going back to it's a new ESG global all cap. It's the new ESG global all cap. Hang on 1 second. I just need to go back up to yours. But you said it was the S&P 500 VUSA accumulation income. That's not the same. See, global all cap. So the VUSA is America. It's the top 500 companies in America. So it's a US fund. The ESG global all cap is a global fund. It's not just America. So that fund and the one that you were referencing earlier, they're not the same thing at all. They're completely different. Where are we? Okay, cool. Thanks to your Twitter present pressure advice, I've gained access back to my mate. Okay, this is good. Mate, this is really good, Kev. Yeah, look, listen, most of these companies, sorry, 1 sec. Most of these companies do not want to see or have on their Twitter feed unhappy customers because everybody can see the Twitter feed. So the minute you go on Twitter, a lot of them are very quick to respond because they know that people will be able to see that they don't respond to issues. So that's good news, mate. That's really good news. Did they give you an explanation though? That's what I'd like to know. What did they say was wrong for them to withhold access to it? That's what I'd really like to know. And I hope they have a really good explanation for it as well. Happy, what's your thoughts on precious metal ETFs like the iShares physical gold and precious metal investing in general? Mate, listen, gold, silver, platinum, all that kind of stuff, palladium, look, those are hedges really. So it's important to have, some of them as part of your portfolio, especially if, you do believe that markets are going to crash, because typically it's precious metals and that kind of stuff that are always a very good hedge against equities because of the finite resource element to it as well. Many people will argue, well, Bitcoin is also worthwhile having, but obviously with Bitcoin, it's very, 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 very volatile at this point in time. I've not actually checked. I've not actually checked what's going on with Bitcoin at the moment, because the last few days, maybe 3 or 4 days, has been absolutely phenomenal. And if it does punch through, I mean, like the video yesterday, I talked about the fact that, there are ETFs being lined up to be approved by the SEC in America. And if that does happen, it's going to be absolutely nuts, because what you will find is you will have a ton of institutional money go into Bitcoin as they seek to diversify their portfolios into a different asset class. And that's going to really just pump the price of Bitcoin like crazy. What's Bitcoin right now? Bitcoin is at 57,000 right now. So if I have a look at this chart, see, there's a lot of contention at the moment around Bitcoin and what people are saying, if you look at the resistant levels, I think the resistance was around at 55, 56. What they're saying is if it can break 56 up towards 57, then it's a straight shot to 65 and 100. I don't know whether some of the commentary, and this is from day traders, obviously, and I don't know whether some of that commentary is already factored in what I pointed out in the video yesterday around the SEC having in the diary to approve for Bitcoin ETFs. I don't know whether that falls as part of it, but mate, it's an extremely exciting time right now in Bitcoin land. It really, really is. If they get approved, from November the 21st onwards through November and through December, and I actually had a look, Bitcoin performs extremely well over Christmas, average return about 30% over that period of time. It could be very, very exciting. And I think if it does get approved, 65,000 a coin is going to be, it's going to be the beginning. If they start getting, ETFs and all of the stuff approved across different jurisdictions, and you can get the pension funds involved, game over, mate. 500K a coin would be well within reach. It's very, 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 very exciting. So, right, let me just have a look at where are we? Where is this question? Where was I? Dude, one second. Let me just see if I saw this right. Dude, Kevin, mate, listen, I appreciate you. Thank you so much, man. Really do appreciate that. Thank you very, very much. £20. That's really, really great, mate. Thank you very much for that. Thank you for the support as well. Right, let me just find, where was I in this? Here we go. Right. Hi, Pete. What's the best way to invest in the Ftse 100 index from an ISA? Right. They do have, if you want a provider, I mean, look, I'm just trying not to be trying to mention Vanguard, because they're not the only ones that can do this, but they do have a Ftse 100 ETF in Vanguard. It's this one right here. That's the wrong window. Is it this one? There we go. Is that the right one? Yeah. So it is this one. Bear me 1 second. I might need to shrink this. There we go. Is this one right here, mate? So you can access this one pretty easy. The cost for this is only 0.09%, mate. So it's really, really cheap. I mean, the thing is, right, if you're going to go into the UK, obviously we do have domestic issues here. I mean, they're talking about interest rates increasing, by the end of the year. That will cause a little bit of a havoc. It will be great for savers, but mortgages, all that kind of stuff, business, it'll have an impact. So just make sure that if you are interested in this, you're going to have your reasons and done your research and stuff like that. I think, even within the Ftse 100, there'll be a lot of companies in it that are undervalued. So you can access it here, mate. It's relatively easy with Vanguard, and actually really, really cheap. 0.09%. So that's one way that you could access it. I asked many YouTubers for advice, and you're the only one who helped. Mate, well, look, I think this is where, I don't know, mate. Look, I enjoy what I do. I enjoy doing this. I started the channel because I want to be able to help people. Um, but if I'm honest, sometimes I just look at it and think, you know what? If I made more, you can 10x your money videos. My views would be way, 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 way higher. I mean, I've just been away because I've had to. I haven't had any holiday this year at all, and over the last maybe like month or so, I felt like really, really, really run down. Like it's a constant like conveyor belt trying to think up ideas of videos and all this kind of stuff. And one of the things that naturally you deal with, and I have to kind of sense check myself on, is that a lot of time goes into the videos to produce and to write it and to you know film it, to edit it. A lot of the time I'm doing this overnight because I've got things that I need to do during the day. And then when you get the video out and then the videos are low, you're like, and I struggle with it over the last month or two. And in the end, I said to my partner, I said, I feel really run down because there's a lot of work that goes into it, and it doesn't feel as though it's reaching people. It doesn't feel as though it's coming across or helping people in the way that it was during the summer when it was just nuts and the views were crazy. And it's a human reaction. It's like put on a lot of work. And I was away last week thinking, okay, so do I taper back the videos to once a week so that I've got more time for myself if the views aren't going to be that much, or do I keep it at 2 videos a week? These are all just kind of things that I'm trying to get the channel to grow and consistency to grow. Use my skill set. I am a qualified financial advisor, so I have worked with these things for a very long time. So of course I want to be able to relay that information and do all that kind of stuff. A lot of other YouTubers can't do that because they don't have my experience. They don't have my expertise and stuff. And so, it's really one of those situations where I'm kind of like I don't know, I'm in a little bit of a limbo at the minute in terms of what I'm going to do with the channel to move things forward, to actually grow things forward. Yeah, I don't know. I haven't decided just yet. I've got so many ideas as well that I want to produce and ideas of things that I want to be able to put out on the channel. But the issue is that, if I spend 2 days on a video and that video nets me 100 quid in AdSense revenue, it doesn't justify me putting £2,000-3,000 into a video series if each of those videos are going to net me 100 quid in AdSense. It makes no sense whatsoever. So whilst I want to produce that kind of content, it will be more interactive and more interesting. It will definitely be more interesting. I've got to weigh up the financial commitment that I have to put up front to produce it, because unfortunately I can't do it on my own. I'm going to have a team of people. I'm going to have to hire a studio. I'm going to have a videographer. I'm going to have an editor. I'm going to have people to do lighting and audio. That all costs money. So I don't know. It's a weird place, but this kind of feedback is really, really good and it works for me. It really, really does. Thank you. I read that VUSA distributes income quarterly, whilst VUAG accumulates income. Maybe some incorrect information out there. Both are Vanguard. I've not noticed that. I mean, maybe because I don't necessarily care about income distribution. So I normally go for accumulation funds. And as long as it's an accumulation fund, then I know that the money is going to be reinvested the entire time. I've never noticed in the VUSA that they distribute income quarterly. I've never noticed that. Doesn't mean that you're not right though, but I've never really paid attention to it because one of my big things is I don't really care if it does distribute that money quarterly. I just want it to be reinvested, and that's my investment goal overall, really, to be fair. He's representative of global stupidity that punks get more views. I just hope you're aware that your worth far far exceeds theirs, and it will pay off. Look, that's hopeful. Long game at the end of the day. It is a long term strategy for me here on the channel, and I know that I'm very very different. I know that ultimately, yeah, I don't necessarily do clickbait stuff, or I try not to. But sometimes I do think to myself and think, for the hours that I put in for the videos, maybe I should do something that is going to be clickbait, just to make it worth actually producing the video in the first place. But cheers for that, mate. Appreciate it. Cheers, Josh. Top things to research before investing. Top things to research before investing in individual stock. You need to be having a looking at what the company profile. What do they do? What do they sell? Do they have a competitive advantage on what in the area that they operate? And you need to know how to read company accounts so that you can get the fundamental analysis done within the company, so that you know what the numbers are telling you. Essentially, if you don't know how to do that, you can use things like Simply Wall Street. Simply Wall Street is a really good tool that will basically do a lot of that stuff for you and give you kind of outputs. But you still need to understand what that data means, and that's where you might need to do a little bit of further work around the language. All right, I'm just looking at time. An hour 16. All right, there's quite a few that I haven't been able to get to. Apologies, guys. But yeah, it's a Wednesday evening. I wasn't going to do it. I thought I'd just do it impromptu anyway, this evening. But yeah, guys, thank you so much for watching, and thank you to everyone who super chatted as well. Trust me, it helps a lot. You have no idea. I'm actually exploring a way of being able to provide. I've got the meeting tomorrow, because one thing that I've become acutely aware of, and I've noticed this with coaching, is that people they get value from videos, but where they really really need help is in the practical application of things. And I can answer questions on here, but sometimes, because I don't know as much detail, it's hard for me to give you very specific things. So I'm having a meeting tomorrow that could potentially introduce a way for people to ask me questions. I will ask for information, and once the information is provided to me, I will be able to give you an answer based on the information that you give me. So I've got that meeting tomorrow to see how it actually works. The response will be video, so you'll get a video with the explanation and the answer to your question. So I'm having that meeting tomorrow. Once I've had that meeting, then maybe on the next live, I'll say a little bit more about it and stuff. But that's a really, really interesting way, maybe to help people a little bit more, so you can get a bit more of my brain and how to work things practically. I'm looking at doing something in the new year as well, just a program to help people get, their money situation and their finances all together, from budgeting all the way to the investing and everything, basically, to get it in a bow. It will be a program that will either be 4 or 6 weeks long. And what I'll do is I'll open it up to a cohort of people, because it's all about making sure that we don't have that many people on to the point that people feel as though it's crowded. And the idea behind that is, over the 4 to 6 weeks period, we'll do a meet every single week with tasks, things that people need to do. But I'm building it out at the moment. You'll hear a little bit more about that a bit later on. But guys, I really do appreciate you joining me this evening. There'll be a video on Friday. There are so many topics that I want to talk about. But yeah, we will get through to them surely at some point. But guys, whatever you're doing this week, make sure that you have an amazing week. I will see you on Friday.